I really do believe that it's going to be a better decision than I would individually make. We don't have a situation where we have a big debt crisis on the horizon. We have a debt squeeze that'll emerge on the horizon. What is important in this cycle is that we have a big difference in the financial conditions of different people. The rich and the poor, the polarities become greater. And so we have greater amount of populism that exists now, which would make the next downturn in the economy more difficult. There'll be more conflict. Populism is a big effect. And then we also have the emergence of China, and to some extent India, but particularly China, in terms of competition. Most importantly, China in terms of the geopolitical and being all over the world. So I would say that's the character of the environment in relationship to the cycles. All these cycles have happened over and over again, and the period we're in is quite like the late 1930s, because central banks don't have much ability to ease if they're turning down, and they're beginning to tighten monetary policy. 1937 is when the Federal Reserve and some other central banks tightened monetary policy, and we're in a position similar to that now, I think.
Just like the economy, debt crises tend to operate in a cycle. This can be beneficial or detrimental to the individual depending on the situation. These dips can progress just like a disease, but luckily for the wary investor, you may be able to spot when they are coming. The devaluation of money happens regularly in the economy as well. Think 1970s when the gold standard changed for the US dollar. These times can present some painful lessons, but with these lessons comes reflection and the adoption of principles. Learn from the shortcomings you encounter and use the economy to your advantage. And with these principles you've learned, you'll be ready and more prepared. Obviously, a debt crisis is dependent on a number of factors, but a large one is the disparagement between the poor and the wealthy, and how that affects the populism of the time. The larger the gap, the larger the potential loss of revenues. Another factor is the geopolitical relationships between the world's superpowers, especially China, and how the spending of their economy affects the market. This cycle of debt and income is dependent on the current amount of debt held. When money is borrowed, that money is spent and it becomes someone else's income, which has a positive effect. Over time, though, this can raise the amount of debt higher than that of revenue. And when you have higher debt, you're on the verge of a debt crisis. To combat this, interest rates need to drop to incentivize more spending and to even out that ratio. If you do decide to invest wisely and keep an eye out for the signs that the market gives you.
The first time I was clerking on the floor of the New York Stock Exchange in 1971, and nobody was accepting dollars. And then I came on August 15th. President of the United States basically says, you're no longer going to get the gold, and we're not going to do that. I walk on the clerking on the floor of the exchange. I figured, wow, what a crisis. We're going to be down a lot. Stock market was up a lot. I didn't know what a currency devaluation was, but they happened many times. The 70s and so on, along those lines, things that happened in my lifetime. And I got in a habit of every time I would make a decision, particularly painful decisions, that was my cue that I need to do more research. Every time I would, I have an expression, pain plus reflection equals progress. So I started, if I have a painful experience, when I calm myself down, I would say, what can I learn? And I would go back and I would study that, and then I would take that learning and I would write down a principle. I wrote it down. And by the way, I would recommend that you do that. Pain plus reflection. You're going to learn mostly through your pains, and then you reflect well, learn the lessons, take in from others, and do your research. And I would then write that down. So what we have is a credit cycle. If there's not much debt, if you don't have much debt, then you have the ability to borrow money. Let's say you earn $100,000 a year and you don't have any debt, you can then borrow $10,000 a year. You therefore can spend $110,000. Your spending of $110,000 is somebody else's income of $110,000. So it has a positive effect, and you go through a cycle. And through that cycle, you spend $110,000, they earn $110,000, and the cycle becomes self-reinforcing.
Through that cycle, debt rises faster than income. Debt rises faster than income. Debt can't rise faster than income forever. So as debt rises faster than income, you have a debt cycle. What causes it to stop? Well, traditionally, as you lower interest rates, debt has three positive effects. If interest rates are too high, then you lower interest rates. Lowering interest rates has the effect of making it easier to service the debt. It has the effect of making items cheaper to buy on credit because the monthly payments are less. It has a present value effect on assets. So if you lower interest rates and you have something that has a cash flow, let's say a piece of real estate or something, they have a present value effect. It causes those assets to go up. That produces wealth, and that allows more borrowing. And so when you get to a situation where you can't lower interest rates anymore, let's say you hit zero, that part of the cycle ends.
Well, I mean, it's like any reality. You got to embrace the reality and know how to deal with it. Yeah, there are debt cycles, and debt cycles provide great opportunities, and they provide real problems. So I think it's just like a progression, a disease that progresses. And the reason I wrote the book was just a compendium of research that I wrote mostly before the financial crisis. And it's because I think it's essential for everybody to understand the sequence of events, the logical sequence of events that makes these all the same. So as you know, there's 48 of them in there. They all play out pretty much the same way, except there are inflationary and deflationary ones depending on the currency. But basically, in 60 pages, I just want to convey that template.
Thank you for watching. If you enjoyed this video, be sure to like, comment, share, and subscribe for more content.